European markets touch record highs as inflation eases. Welcome to Market Insight. I'm Ludovica Brignola. Eurozone inflation fell sharply to a three-year low of 2.2% in August, reinforcing expectations that the European Central Bank will reduce interest rates next month. But core inflation remains stubbornly higher at 2.8% in August. Well, what does it all mean for equity markets ahead of the ECB cutting cycle? To help answer all that and more, I'm joined by Anna Macdonald. She's an independent equity analyst. Thank you very much for being with us today. Right, so inflation fell sharply. Core inflation, though, is still somewhat high at 2.8% in August. What does this mean for equity markets and for the ECB?
As you mentioned, equity markets are hitting new highs today in Europe, and that's because I think that the ECB are slated to do a quarter-point cut in less than a couple of weeks' time, and I think there's probably a couple more rate cuts to happen in the months ahead before the end of the year, which is positive for equity markets. You're right, the core inflation number is a bit high, and actually has risen, particularly in France. Now, what that means is there could be some worries that wage inflation is becoming entrenched. However, I would say that the ECB's chief economist Philip Lane said that wage inflation growth seemed to be peaking, which is possibly another positive aspect when we're looking at for future inflation numbers.
Right, interesting. And the sell-off that we saw at the beginning of the month in European equity markets in particular, I mean, was the sell-off only due to positioning, do you think, or is there something more to worry about?
Well, it was fascinating, actually. It was such a dramatic move, and it wasn't just Europe. We saw massive falls in Japan and in the US as well. And it seemed to give everyone a bit of a fright. But it's amazing how the markets have actually just recovered those losses and more. So I think there was, possibly once you've had elevated, once markets have been a bit of a tear, there's a temptation for profit taking. But really, I think we are seeing a broadening out away from some of the Magnificent Seven stocks into the other 493 S&P stocks, and also other economies looking like they're on a slightly more solid footing, and people looking forward to some gentle economic growth going forward.
Right, and Europe's largest economy, Germany, really seems to be struggling right now. I mean, earlier in the week, we saw GDP data, but also manufacturing and inflation, especially. What do you make of these data?
Well, I mean, remember that Germany is an exporter, and one of the countries to which they export a lot is China, and we are seeing pretty weak economic data coming out of China, with quite a lot of moves there that we're hearing about to try and reinvigorate the Chinese consumer in particular. We're talking about the ability to refinance several $1 trillion worth of mortgages, for example. So I think that should provide some boost. But yes, Germany has been the sort of sluggish constituents of the EU area, and that is a lot to do with, as I say, manufacturing, exporting. They've been hit by energy costs, which should be peaking, and that should be positive.
Right, and ahead of September and ahead of the continuation of the ECB cutting cycle, I mean, do you think the sector rotation is continuing, and what sectors would you rotate out of and into ahead of the cutting cycle?
Well, what you want to think about are those sectors where they benefit from lower rates. And that's when you see a lot, particularly, it's not just in Europe, but we've seen quite a rally in smaller cap indices in the US on the basis of that too, because some of these smaller companies will really benefit from being able to borrow at less expensively. Some of the larger companies already have quite significant refinancing in place. So I think some of those smaller companies and those kind of companies will be doing well. Hopefully, some consumer names will start to benefit from lower inflation and the lower interest rates. And we've also seen, Signs, I mean, it's very volatile, these numbers, but in the UK and the US, there's been numbers this week. A bit of weakness in the housing market, new starts for the US, but we are seeing generally more buoyancy in the housing market.
Right. And on your last point, in the US, what do you predict for the tech sector? Because despite the strong results, Nvidia somehow disappointed the markets, right? Is this a sign that expectations there are excessive?
Well, they didn't hit the whisper number of growth that some analysts were hoping for. But you've got to remember that Nvidia has more than doubled this year. It's really run very strongly into results. So there's a lot. There are very high expectations out there. As I say, you could be seeing a rotation into some of the other names, which are starting out, which are also doing pretty well and going to benefit from the boom in AI. Nvidia did talk about not production difficulties, but it's taking a while to get the Blackwell chip mask all ready. But I mean, I think the CEO on his call was still trying to be fairly bullish in terms of there are lots of applications and the huge revenue expectations for next year. But this is a company that is already on a pretty high valuation, and one that's done extremely well.
That was great. Thank you very much for your insights, Anna Macdonald, independent equity analyst. And that is Market Insight. Don't forget, you can watch more videos on Reuters.com.